Hi everyone, this is Tony D'Amico with Fidato Wealth, and this video today is to do a review of the markets for the first half of 2018. So I really believe some of this information that I'll share with you, I think you'll find educational and provide you insight into not only what the first half of 2018 has been like, but also just a reminder of some other key fundamentals as far as how we view the markets. So let's kind of look at what returns have been like over the past 6 months. So what we see here, this is a chart that I keep up on my computer, and it shows the different investments that we're in and the returns over that period of time. So this is year-to-date returns and all the funds that we're in and what the return is before our management fee is on this side. And you can see that returns have not been good. They've been pretty lousy year to date. And what we do also see is that all these different lines are, they're kind of a spider web, if you will, and that's intentional. And one of the protections that you have in place is that you have a globally diversified portfolio. So we would expect these asset classes to not be moving in conjunction. We want them to be, while certain investments are not doing well, others to be doing better. And we can see that dispersion, as we call it, with these different investments. So year-to-date returns have been lousy, but let's look at the past year. That's a much different chart. And what you can see is that, real estate and bonds are down over the past 12 months, but international stocks, emerging markets, and U.S. domestic stocks are all up. So, that is a much different picture. And I think it also highlights, there was a really good interview recently with Warren Buffett on CNBC, and he talked about some of the mistakes and dangers that can happen by looking at financial data over a short period of times and making decisions. And he warned investors and companies that you can't just look at the quarterly results. And sometimes he's seen companies make the wrong move by looking at their financial earnings over a quarter, and by making the wrong move, it hurt them long term. And so he's talking about how companies manage their financial picture and their return on capital. But I think there's some parallels as well there for investors. And just like how Warren Buffett invests in stocks, there's stocks and bonds that you own in your portfolios through the funds that you own. And I think that parallel is there, that you can't just look at a 6-month period or a 3-month period, because every 3-month period or 6-month period or even 1-year period is not positive in the market. So we do know that. But again, if you look at this one year data, it paints a much different picture. So again, it's been a great 1 year. And every 6-month period isn't going to be up. But just to look at the past 5 years, look at the returns. Now, these are total returns. These are not annualized. But there's been significant returns in the market the last 5 years. So again, keep that long-term perspective. Don't just focus on the short term. I think that's really important. So let's kind of start the slides that I've put together for you. And again, I think you'll find this really helpful. We're recording this on June 28th of 2018. All right. So as I mentioned, returns have been lousy year to date, but the market over the past year has done well. It's important to note that we're 9 years into the second largest bull market in U.S. history. And a fair question is the softness in the market year to date evidence that there's a recession looming? All right, so let's look at some key economic points, and let's look at what the Labor Department is saying. So according to the Department of Labor, people are working more than ever in history, and they're making more money than ever. The economy added jobs pretty much everywhere in every sector. We also see the Labor Department is projecting unemployment to run low through 2020. And the average hourly earnings of 82% of the private sector workforce rose nearly 3% over the last year. And that's the biggest advance since 2009. So in a nutshell, more people are working than ever in history, and they're making more money than ever in history. So let's take a look at the Federal Reserve. So recently, the Fed raised interest rates a 1/4 percentage point, and they also indicated that 2 more rate increases are likely this year. So the target is now 1.7 to 2%. And the Fed has said that economic growth has been rising at a solid rate and noted that unemployment has declined and household spending has picked up. And household spending has picked up dramatically. So these are very strong words from the Fed. And most of you know the Fed raises interest rates to make sure that inflation stays in check. Because what history shows us is that if there's runaway inflation, that has a tremendous blow to an economy. So they know it's better to raise interest rates to keep growth in check. That's their goal. So not only have they raised rates twice, they're going to do it 2 more times at least, they're saying. And what that means is the Fed is highly confident that the current economic growth of our nation is going to be sustained for a while. So as I mentioned, we're already in year 9 of a bull market. It's one of the longest stretches of economic expansion without a recession in U.S. history. And the Fed is saying there's no recession anywhere on the horizon. So let's take a look at data from U.S. companies. So Reuters reports that U.S. corporations are making even more money than expected. 78% of the companies in the S&P have reported earnings above analysts' expectations. So again, that is also very significant. First quarter earnings increased 27% compared to a year ago. That is also very substantial. U.S. companies are also flush with cash. They received a $1.5 trillion windfall from the new tax law that went into effect at the beginning of this year. And that is on top of the several trillion dollars companies have already been sitting on. So what are the different options for these companies? They're sitting on this cash, and they don't want to sit on the cash. They want to get a return on their capital. So they have 3 options. One is they could buy back their company shares. The second is they can pay dividends to their shareholders. Or the third is they can reinvest in their businesses. So, by the nature of wages going up, unemployment being low, the capital improvements that companies have made, reinvesting has already happened to a significant level, and they already have paid dividends. And not all companies do pay dividends, and that's okay, because when a company pays a dividend to the shareholder, what they're saying is, Mr. and Mrs. Shareholder, we're going to give you your capital back. We're going to give you a return on your capital. Here's a portion of our profits. We're going to give it to you because we can't get a better return ourselves for you. And so not all corporations want to pay dividends, but it has happened. So what we see is that companies bought back in the first quarter of this year about $178 billion worth of their stock. That's a 42% increase from the amount of buybacks that they did last year. So that's significant. And I think it's just, let's think about that for a minute. So companies and their CEOs are saying, our best return on our capital is to buy back our stock. Let's buy some stock. Let's buy our company stock. So you have to, I guess it's prudent to assume that they know their business is probably better than we do or any analyst does. And you have to ask yourself, what do they know that we don't know? And why are they so confident that that was the best return on their capital out of all the options available to them? So I really think that's important to think about. And they did it during last quarter, which there was some decline in the market. They didn't do it last year, right? So obviously their goal is not to buy high and sell low. So do they think a recession is looming? Their actions don't appear to that they believe that. So that was a very bold move to buy that much back of much of their stock back. So let's take a look at household wealth. So consumer sentiment remains near at an all-time high, according to the Michigan Consumer Sentiment Survey. The Commerce Department says consumer spending and retail sales rose in May to their highest level in 6 months, exceeding forecasts and bolstering expectations for another acceleration in economic growth this quarter. So overall sales grew twice as much as expected by economists. Total household wealth, that's the net worth of households across the country, now exceeds $100 trillion. That's up almost 50% from 2008. All right, so what are some concluding points? So number one is, as you look at your investment accounts or your brokerage statements or even your 401k at work, or as you look at your returns, I guess my advice is, if you're going to look with the right perspective, or maybe just stop looking. If it's going to cause you to get upset, or if it's going to cause you to wonder if to rethink your long-term strategy, I don't think that's good. So remember what I kind of shared with you about Warren Buffett, and maybe Google that and watch that video. I think that also might help you. And so don't let the current events and recent news and interfere with your long-term goals. I really think it's as simple as that. So again, not every 6-month period is going to be up. Not every 3-month period is going to be up. Not every 1-year period is going to be up. So again, you have to understand that. And I know that we track your investment returns that you've had with us since inception, and we post that report to you quarterly into your portal. I really wish that all of us had a report that tracked what our returns have been over our lifetime. I mean, that would be just phenomenal information for you to see. What has been the return on your capital since the first time you invested in your 401k or mutual fund you bought, however you got that. And none of us have that data. And, but that would really be helpful. So again, keep that long-term perspective in mind. Don't let the short-term noise get in the way of spoiling your long-term plans. All right. Well, I hope you found this information very helpful. I really hope it helps you just get an understanding of what the first 6 months have been like from a return basis, but also see what's happening out there. What's the Department of Labor saying? What's the Fed doing? What are corporations and their CEOs doing? And looking at those different data points. So again, I hope you learned a lot. I hope this gives you a good peace of mind, and we look forward to seeing you soon. Thanks so much. Have a great day.